So in this short episode, we are going to discuss, does signing up for Robinhood make you a better investor? If you're interested in learning more about that, continue listening. So welcome to the Red to Black podcast with your hosts Warner and Mario. And today we're discussing, when you sign up for Robinhood, does that make you a better investor? So to start this one off, I'm going to talk a little bit about Robinhood. Robinhood is an online brokerage account. You can basically sign up real quickly. I think they may offer you free stocks. I'm not sure. But anyways, if you sign up for this account and you put money in and you start trading on Robinhood, does that make you a better investor? My answer is no, it doesn't, because the same rules of investing apply no matter whether or not you're on a tech platform, if you're going through a broker, or if you're doing it yourself. It's all dependent on the quality of the business you're picking. Are you picking high quality businesses, and are you buying them at a great price? Because over the long term, 20, 30, or 40 years, you're going to see which business is actually going to still be in business. And if you're part of those businesses and they spin off cash, like a cash cow, then you're going to profit from those businesses. Mario, what are your thoughts?
If you're checking the price of a stock every day, you're not an investor. You're speculating. You're looking at momentum. You care about which direction the price goes. An investor is making a long-term bet on the future of the business. You should be stacking up a huge piece of cash and shoving that entire piece of cake into a deal, and then sitting on that for a long time. In fact, sitting on that forever is the best holding period. Yeah, Robinhood doesn't make you a better investor.
Yeah, so there's this great thing about branding and sales and marketing. If you're not paying attention to what the foundational areas of a business are, if you're not building yourself up to be a foundationally sound investor, then you're going to get caught by this marketing or this euphoria. Oh, Robinhood, it's so great. I can get into this company quickly. I can sign up for an account. They make it so easily. They've got these great services where they tell me what to invest in. I can see the trends going up and down. Whatever it is, they're leveraging tech in a way to kind of, I would say deceive you. Because if you're not looking at the underlying fundamentals, like you're saying, Mario, then what are you investing in? You're investing in euphoria. Again, it goes back to, go ahead.
Oh, it's a casino, Warner. They've turned it into a casino. People are coming in there for an adrenaline rush. They're gambling. It's not a shrewd business investment. It's entertainment. They've turned it into an entertainment industry through these online apps. It's like a casino.
Yeah, and that's the challenge for our listeners is anytime you see something new or flashy, always there's a warning sign that goes off in your head. And that warning sign is this: hey, did I evaluate the underlying economics of that business? Because if I haven't, it's like what Mario said, you're just playing Russian roulette. I mean, I've done it before where I'll be honest with the viewers, I'll tell them myself, I invested in a 300x inverse, one of the worst decisions I've ever done. It was not much money at all, because I'm not that type of investor where I'm going to take a speculative bet and put it all in. I'm going to take a small amount. But I learned a very important lesson. What those guys do is they're constantly doing the inverse of the market, 300x. And what I noticed over the long term, over the past few years, they're doing reverse stock splits. So your shares are getting smaller and smaller and smaller. And the reason they're doing that is to make the price look bigger. So it was on my part, it was not a great investment decision because.
No, I disagree.
Why? Yeah, go ahead.
You were right on the market's overvalued. You were wrong on your timing, and that's why you're basically shorting the market. So to explain to the viewers what an inverse fund is, it's shorting the market through options. They're buying options to short the market. You were correct that the market is due for a correction. So your analysis is correct. It's just timing. You're wrong. It's like shorting Tesla. Tesla's a company that could potentially go bankrupt. It's a company that's not making a lot of money and it's burning cash. And a lot of people have shorted it, but you can go years and years and years where they're getting cheap cash or they're getting cheap debt, and they're able to continue to finance operations through debt. So it's not that you were wrong. It's not that it was a bad investment. It's your timing was wrong. And also people that get into Robinhood, they buy a stock and it goes up in price. That doesn't mean that it was a good investment. Their assessment, it's like someone that hits on 19. Even if they draw a 2, it was a bad decision to hit on 19. Okay, you drew a 2. Good for you, but it was wrong for you to hit on 19. Investing in the inverse when you did is not wrong. It was actually it's due for it. It's way overvalued. The stock market's overvalued. It's just timing was wrong. The timing was wrong. You're off on your timing.
I was way off, and I learned a lesson about investing, or I would say I wasn't really investing. I was speculating on what could happen in the market. What I learned about those types of funds is they're not designed to be held for the long term. And you told me that a long time ago. Those funds, those inverse funds, are designed to be held for a short amount of time. And the guys that really know what they're doing, which is very, very, very few, will get in and out at the right times. But they're also hedging their bets going forward, going long. So they know the numbers on where, okay, if I go the downside this much, I have myself hedged at the upside. I was making a bet going to the downside. I guess more to your point, I agree with you in terms of timing. But what I'm saying is I didn't really understand how, the put, the short market, options market, all that stuff. I didn't understand how that works. And I understand it at a basic level right now. But my point is, if you don't really understand it, don't get into it. It's like, here's a great example. It's like, you and I have been skiing before, right? I used to teach skiing, and I've been to Jackson Hole, Wyoming, or I've been going there for the past 20 years. And I've been skiing everything from chutes to really tight trees. Mario's been there. We actually collided on the run one time.
What is it? Alta 3 chutes?
Alta 3, but we were going down a run one time, and I'm
Tower 3. I'm talking Tower 3 chutes. Alta chutes, Tower 3.
Oh yeah, Tower 3 chutes. And I was going down a run one time, and I'm going up over this run, and Mario's trying to keep up with me. And there's this blind spot as you come over, and Mario's doing a turn over this hump as I'm coming down. Hip checks the living, you know what, out of me. And it's like a yard sale. And a yard sale means skis, gloves, helmets, everything's just strewn across the hill. So what I'm saying is if you're going to go skiing, you're never going to go to a place like Jackson Hole and you're going to point your skis down a chute. But that's what metaphorically we do when we invest in stocks. I'm going to go and invest in one of the most challenging markets, which is the options market or the derivatives market. And I'm going to go be successful in it. That's like me saying I've never skied before, and I'm going to go put myself into a chute in Jackson Hole, Wyoming. I guess that's what my point was. But you're right. I had the right mindset in terms of I know what's coming. I just didn't know how to execute on that. So it was an issue between execution and timing as it applies to options.
It's hard. Yeah, it's really hard to be right about shorting a stock or shorting the entire market. The timing's the hardest part. You can be correct. Your analysis can be correct. It's just getting the timing. It's almost impossible. On the other side, being long, when something's really cheap, you're not forced to sell it. Time's in your favor. You buy it cheap and you just sit there and wait. And eventually you'll be proven right. If it's a good company and you bought it cheap enough, now just wait. And there's no penalty for waiting. Yeah. And vice versa. When you're sitting on a huge stack of cash and you're just waiting for 16 to show up at the blackjack table, the dealer's sitting on 16, you're like, okay, now I know that my odds are in my favor. I'm sitting on 20 and the dealer has to hit on 16. I'm pretty much going to win over a long enough period of time. If you're sitting on 20 and the dealer's on 16, it's a great hand. Play that hand.
So what that points to is training and preparation. Because of what Robinhood provides, this easy entry into the market, it enables you as a upcoming or potential investor to forego all the training and the foundational approach that's required to build yourself up as a strong investor. So you can just jump into this market. You can just jump into that chute at Jackson Hole and go for it. And 9 times out of 10, 99.9% of the time, you're going to have a horrific crash. I don't know if you've ever...
It's called tomahawking.
Yeah, you're going to tomahawk, which is just going end over end straight down these steep chutes. So it's not recommended. And And that's why on this channel, our goal is to build you up with a foundational approach to investing so you become stronger investors. And that's why Warren Buffett, one of his quotes, referred to his investing as sloth, or it's not slothful, but he started off with it's lethargic bordering on slothful. It doesn't mean that he's not a hardworking investor and he puts effort in, because every day he's reading nonstop looking for deals. What he's doing is he's finding the right deal, as Mario said, and he's waiting patiently till it gets to the price. And when he buys it, he's buying such a great business that's got such margins of safety, huge moats, resilient brand, huge cash flow, that there's really not many emergencies or problems he's working through after he purchased that business. He's just sitting there and it's producing cash for him. So I think that's about it for this episode. Mario, do you have anything else to add?
Nothing to add, Warner.
Great. Thank you so much. And thank you for our viewers for watching this. We appreciate your time. Please like, subscribe, comment, share this with your friends. And we're also posting articles at the redtoblackpodcast.com. So check us out over there. Thank you so much for your time.